learners, welcome to the Academy of Commerce and Management. Today, we are going to study about insurance. This is the last chapter of Banking and Financial Institution module. Once again, welcome to the Academy of Commerce and Management. What is insurance? Insurance is a legal agreement between two entities, the insurance company and the individual or group. The insurance company is called the insurer and the individual or group as the insured. The insured pays a sum of money to the insurer with the understanding that the insurer will compensate them in the event of a financial loss due to the causes specified in the insurance policy. The money so paid by the insured to the insurer is known as premium. Now, let us see the functions of insurance. First function is insurance provides safety and security to the insured. The primary motivation for purchasing insurance is to gain financial protection against unexpected events. Insurance provides a safety net for policyholders and reduces uncertainties in business or personal life. Insurance cannot prevent unfortunate events from happening, but it can provide financial assistance to compensate the insured party. Second function is insurance safeguards the loved ones of the insured. Health insurance ensures that you and your family receive the necessary medical care and covers hospital expenses. It protects their health in case of accidents, illnesses, or other unforeseen events. Insurance plays a vital role in ensuring the well-being of your family. The third function of insurance is collective risks. Insurance allows a group of individuals to protect themselves from potential losses due to unfortunate events. This strategy works under the assumption that not all policyholders will face the same risk simultaneously. For instance, out of a group of 50,000 people insured against car accidents, only a handful may experience accidents within a given year. The insurance premiums paid by all 50,000 policyholders would adequately cover the financial losses incurred due to these accidents. The fourth function is risk assessment. Insurance companies play a crucial role in calculating the actual risk associated with a particular event. They thoroughly analyze all aspects of a risk to make an informed decision. This process helps them to determine the final insurance amount and the premium to be paid by the insured. The fifth function of insurance is certainty. One of the main advantages for the insured is the assurance of financial support in case of future losses. This security allows the insured party to carry on with their daily activities without fear or hesitation. The sixth function is insurance prevents losses. Insurance can help the insured to reduce their losses by providing a safety net in the event of an unexpected incident. It allows businesses to have a backup plan in case things don't go as planned. Insurance is crucial for organizations as it allows them to mitigate risks by paying a relatively small premium. And the last function of insurance is it fulfills the legal requirements. Certain countries require businesses to have specific insurance covers to conduct economic activities. Insurance companies can help organizations meet these requirements. Next, let us discuss the principles of insurance. First and foremost important function of insurance is utmost good faith. It is the fundamental principle of insurance in which both the parties should act in good faith towards each other. Both the insurer and the insured must provide clear and concise information with regards to the terms and conditions of the insurance policy. Example of utmost good faith principle is when Mr. X took a health insurance policy. However, at the time of taking the policy, he was a chain smoker, but did not inform the insurance company. Later, he was diagnosed with cancer. In this situation, the insurance company does not become liable to bear the financial burden as Mr. X hid the fact that he was a chain smoker. The second principle is proximate cause. It is also called causa proxima or the nearest cause. Proximate cause implies when the loss is the result of two or more causes. The insurance provider shall investigate the nearest cause of the loss to the property. If the proximate cause is the one in which the property is insured, then the insurer is liable to pay the compensation. However, if it is not the cause to which the property is insured, then the insurer is not liable to pay the compensation. Example of proximate cause principle is, a wall of a building was damaged due to fire and the authorities ordered it to be demolished. During the demolition, the adjoining wall also gets damaged. The owner of the adjoining wall's building would claim the loss under fire policy. The court considers fire as the nearest cause of loss to the adjoining wall of the building, hence the claim becomes payable as the damage to the wall is considered as an inevitable cause of fire. The third principle of insurance is insurance interest. As per the principle of insurance interest, the insured must have an insurable interest in the property. Insurable interest of the insured property means that such property must be of some financial benefit to the insured, as well as lead to a financial loss in case there is any damage or destruction caused to it. For example, the owner of a stationery shop has an insurable interest in the shop as he is earning money from it. However, if he sells or leases his shop, he will no longer have an insurable interest in it. In order to claim the insurance amount, the insured should be the owner of the property both at the time of entering into the contract and at the time of any loss taking place to it. Next principle is indemnity. Indemnity implies that the insurance is done only to cover the loss, hence the insured should not derive any profit from the insurance contract. The insured should only be compensated to the extent of the actual loss incurred and not the amount exceeding the loss. The principle of indemnity aims to set back the insured at the same financial position he was before incurring the loss. Principle of indemnity strictly implies for property insurance and is not applicable to life insurance. For example, the owner of a residential building takes an insurance contract to recover the costs for any loss or damage to the property in the future. If the building faces any kind of structural damage due to fire, the insurance company shall make an indemnifying compensation to the owner for the costs to repair the building. The compensation is the exact amount spent on the repair or reconstruction of the damaged areas by the authorized contractors. Another important principle of insurance is subrogation. Subrogation refers to the situation when one party stands on behalf of another. Under the principle of subrogation, once the insured is compensated for the losses incurred to him for the insured property, the rights of the ownership of such property transfers to the insurer. Thus, subrogation gives the right to the insurer to claim the amount of loss from the third party. Example of subrogation principle is when Mr. X sustains injuries in a road accident due to irresponsible driving of a third party. The insurer shall compensate Mr. X for the losses incurred as well as sue the third party for the recovery of the compensated amount. The sixth principle is contribution. The principle of contribution applies when the insured entity takes more than one insurance policy for one and the same property. Principle of contribution is similar to the principle of indemnity, such that the insured shall not be able to derive profits through an insurance claim on one insured property by opting for different policies and/or companies. For example, the owner of a property worth Rs 5 lakhs insures it for Rs 1 lakhs from insurer A and Rs 3 lakh from insurer B. In case of any damage to the property, the owner can claim the full amount of Rs 3 lakh from insurer B, but not from the other. Besides, insurer B can claim the proportional amount reimbursed value from insurer A. The last principle of insurance is loss minimization. As per the principle of loss minimization, it is obligatory for the insured to take necessary actions to minimize the loss to the insured property. The principle of loss minimization states that the owner cannot be irresponsible or negligent about their insured property. For example, in case fire breaks out at a commercial building, the insured owner of it should take necessary actions to minimize the loss by putting out the fire. The owner should not take it easy and allow the fire to engulf the property knowing that it is insured and that the insurer shall pay for it. What are the different types of insurance? There are majorly two types of insurance. Number 1, life insurance, and Number 2, general insurance or non-life insurance. The first type of insurance is life insurance. Life insurance type insures a person's life. They can receive the claim as per the contract terms. Usually, the money goes to their family if the person passes away. This insurance helps financially support one's family. Various types of life insurance include: Number 1, whole life policy. This insurance type is paid to the nominee. The nominee is decided by the insured. They are often the dependents or family members. The claim is paid when the insured passes. The premium requirement can be for the whole life. It may also range from 20 to 30 years. It varies as per the claim amount. This policy is to ensure that one's family members have enough financial support. Number 2, endowment life policy. This type allows the claim amount either when the insured passes or after the period ends. This period is pre-decided. The insured receives the sum if they live even after the decided period. Their family or nominee get the money if they pass away. This insurance type ensures that one gets the claim even if they survive. Number 3, joint life policy. This life policy is for two people. It can be a husband-wife couple or even business partners. Both insured persons pay the premium. It may be a total amount for both. The premium may also be paid individually by them. The payout happens when one of the insured passes away. The other receives the claim. Also, the policy ends with the passing of one of them. Number 4, annuity policy. These types of insurance are based on age. The insured person receives the claim amount on a timely basis. It can be monthly, quarterly, or a year. The claims often start when the person attains a specific age. This age is pre-decided in the contract. Parents often take these types of insurance for their children. The payments start as they turn 18 or older. And, number 5 is, children's endowment policy. This type of insurance often covers children's education or marriage costs. The insured receives the claim amount when they reach the mentioned age. It helps avoid a big payout. The second type of insurance is non-life insurance. The non-life of general insurance is for other events or losses than life. It helps cover financial losses for different events. It can be health bills, car damages, marine transportation, etc. Various types of general insurance include: Number 1, fire insurance. This insurance type covers the damages from a fire. It can be property or goods destroyed by an accidental fire. Businesses often take this insurance for their warehouse goods. Also, such types of insurance need renewal. It is usually for a year. The condition is that the loss should be calculable. Also, the fire should not be intentional, but a pure accident. Number 2, marine insurance. This type of insurance is for sea perils. A company may take it during sea transportation. It helps recover losses if goods get damaged by a collision, fire, or pirates. Also, this insurance may only be for a transportation period. It may also be for a longer period and cover several shipments. Read below the insurance types in marine insurance. Number 3, health insurance. This insurance is a common one in the types of insurance for individuals. It covers healthcare costs or bills. The contract covers specific illnesses. The insured can claim their expenses or make the payments cashless with their insurance. The health types of insurance also require amounts. The insured may choose any lump sum payment. Number 4, motor vehicle insurance. The types of insurance are for vehicles. The insurer covers damages for any accidents. Also, the claim is only for unintentional damages. Number 5, cattle insurance. This insurance provides the claim to the cattle owner. It is when the cattle die due to pregnancy, sickness, or accidents. Number 6, crop insurance. The farmers can get these types of insurance to protect their income. They can claim the sum if their crops get destroyed due to area floods or droughts. And, number 7, burglary insurance. This insurance recovers damages from stolen goods. The insured may claim the stolen goods price or the damages from the robbery. Next, let us discuss the concept risk in insurance. Risk means the probability or chance of an adverse event happening. This event can lead to financial loss for the person. The classification of risk in insurance is essential for companies. It helps them correctly charge for the policies. People with a lower risk pay less. Ones with a higher probability are to pay more. There are several risk types which are present in insurance. People take insurance for such risks. The covers and policy types also vary with such risk types. One must understand them and ensure that they have measures for financial protection. Important classification of risk in insurance include: Number 1, pure risk. This risk type is when the affected party can only incur a loss or remain in the same position. The individual cannot gain anything from a pure risk event. The companies, for example, may make a loss or cover the costs. It cannot lead to a profit for the firm. An example can be a natural calamity. A person may lose their house in such an event. However, their house may remain the same and not be affected by the calamity. They cannot gain anything in that event. Number 2, speculative risk. This risk type relies on speculation. It means the individual can also profit or gain from such a risk. The loss or no effect factors are still present. The classification of risk in insurance in this type is that the individual may gain, remain in the same position, or incur a loss. An example can be an investment in a company's shares. These shares can appreciate or lose value. They may also trade at the same levels. This case results in speculation. Number 3, financial risk. This risk type is the main base of insurance. Such risks are for events that are bound to make a financial loss. The insurance companies evaluate and cover such losses. For example, a company may lose their goods in a warehouse fire. This event risk is thus a financial loss. The company can take insurance to cover the fire losses. Number 4, non-financial risk. This risk type is related to events where the risk loss is not measurable. Insurance companies cannot quantify the amount. Thus, they don't offer insurance policies for the same. For example, a person cannot avail of any loss if they select a bad phone brand. This risk is usually not insurable. Number 5, particular risk. This risk type is for a particular event that comes up with the actions of an individual or group. It affects only a few people or that group. For example, a car accident is usually localized to the involved parties. They get the damages. Insurance policies are available for such risks. Number 6, fundamental risk. The classification of risk in insurance of this type impacts the population or a big group. Such events are not under anyone's control. They lead to losses for several people. For example, an earthquake usually impacts a big area. Many people face the loss, and this event isn't under their control. Such events can also have insurance policies. Number 7, static risk. These risks have similar levels over the periods. They are the effects of one's actions. Also, the business environment or market doesn't impact such risks. For example, money fraud by an organization's employees is a static risk. The companies usually offer coverage for such risks. And, number 8, dynamic risk. These risks are the results of the market environment and changes. They are often unpredictable. They affect several market players. For example, a new product may significantly shift customer preferences. It can affect all the other companies. Finally, let us discuss about IRDA. The IRDA sets the regulatory framework of insurance. IRDA stands for Insurance Regulatory and Development Authority. This authority controls the Indian insurance domain. IRDA sets rules that are necessary for all insurance companies. How IRDA was established? The IRDA began back in 2000. Earlier, the Indian government regulated the insurance sector. The IRDA was formed as per the Malhotra Committee reports in 1999. It was a standalone insurance apex body. The IRDA started registration applications through invites in August 2000. Foreign companies could also invest up to 26% in this insurance market. This regulating body has defined rules under the Insurance Act of 1938 and Section 114A. These regulations cover rules for protecting policyholders' interests. Also, it has details for insurance business registrations. There are 33 general insurance businesses. The life insurance companies are 24 currently in India. IRDA has some specific objective. First objective is, IRDA aims to promote the policyholders' rights and interests. Second one is, this organization aims for the insurance industry growth. The third one is, there should be swift insurance claims. Also, the body seeks the prevention of fraud in the industry. The next one is, IRDA ensures transparency in the insurance market. Also, the rules provide orderly conduct. And, the last objective is, IRDA regularly creates rules for better insurance market functioning. It helps create an overall better economic environment. What are the roles played by IRDA in Indian insurance sector? First of all, IRDA aims to protect the policyholder interests. It aims to make insurance better for clients. They work to make easy laws. It helps get easy claims. Second, IRDA plays roles in industry growth. The regulatory framework of insurance is a growth driver. It helps create laws that make market entry easier. Businesses can easily enter. Also, customers have better insurance policies and rules. Next, IRDA helps increase market funding. It promotes long-term growth for the insurance industry. The regulatory framework of insurance oversees the industry's work. It helps set higher integrity standards and rules. This also leads to fair dealings for insurance claims. Another role is, IRDA has set a regulatory framework and grievance forums. These bodies help clients complain if they aren't treated correctly. And, finally, IRDA takes regulatory actions if the companies don't follow the rules. It helps in better overall functioning for the market. So, dear learners, this is the end of the chapter Insurance. This is also the end of the module Banking and Financial Institutions. From the very next class onwards, we are going to start new module. We hope that our classes help you in your NET exam preparations. We are planning to conduct some model tests from the already discussed topics. For all our initiatives, we expect your wholehearted support. So, I kindly request you share our videos to your friends and colleagues who are also preparing for various commerce-related examinations, especially for UGC NET examinations. Your support will be a great encouragement for us to do some more advanced videos. Thank you for watching our classes. See you in the next class. Once again, thank you.